And within the first hour of trading, over US $1 billion was exchanged for Deutschmarks. So apparently many bankers and many investment firms were all looking for an alternative to holding US dollars. They all saw that the writing was on the wall, that the dollar was over-leveraged, that there were potential catastrophic events, and they had an immediate flight to Deutschmarks. With $1 billion moving to Deutschmarks, that was a total of 1/12 of our entire gold reserves. This definitely showed that our system of trading currencies was antiquated. And the U.S. policy was changed. It was forced to change. 20 years of holding to the standard, the Vietnam War, the problems with oil starting to develop, with the OPEC nations growing in might, and U.S.'s economy being more based on oil, everything changed. And the Germany deciding to float the Deutschmark finally put the Bretton Woods Agreement to bed. 3 months after the Deutschmark was floated, the U.S. immediately moved off the gold standard. Part of it primarily is they didn't want to be beholden to foreign countries in such a massive way. Immediately you can extrapolate that if Germany, by forcing their currency to float, was able to raise $1 billion, who's to say that Britain, France, and any other country that jumped into the floating bandwagon immediately found a flight to their currencies, and the U.S. dollar forced to be beholden to those central banks. And in releasing the peg, we see the first time that gold is treated as a currency as well. Gold is floated just like all of the other currencies and allowed to reach the level that gold felt, or the investors in gold felt, was where gold should be. And we talked a little bit about this in the last seminar, Speculating with Futures on Traditional Commodities, because this is the same time that the Hunt brothers began to corner silver and gold was being driven up to $800 an ounce. This is all occurring at the same time. Now, one interesting development was that oil, which had pegged itself to the dollar, which was pegged to the gold, saw this shift from the dollar moving off the gold standard and immediately changed their view from being pegged to the dollar to being pegged to gold. And oil basically becomes a default currency in this scenario as well, because as oil floats, it decides to peg itself to the gold, and we see a tenfold increase not only in gold prices, but a tenfold increase in oil prices as well. And it changes the entire economy of the era. The prices jump up in commodities and gold and oil, while the real earnings of Americans just doesn't change, and we see ourselves moving into a negative direction, at the time being forced into stagflation. So the new rules of currency develop, and the European powers decide that there's got to be a way to keep some kind of peg going, or some kind of forced control on currencies, and the Smithsonian Agreement comes into being to replace the Bretton Woods Agreement. And what the Smithsonian Agreement does, it creates what is known as the forward currency market. It's the precursor to futures. Forwards are the precursor to futures. We talked about that in the last seminar, in which people are capable of making customized contracts with one another for customized amounts and delivery dates for currency. And the Smithsonian Agreement legitimizes this practice. And it also finally legitimizes the euro-dollar phenomena. And so we see the development not only of floating currencies at this time, but we see the creation of practically 3 new currencies as well. We see the gold being developed as a currency, we see oil being developed as a type of currency, and we see the euro-dollar becoming a viable type of currency for those who are getting loans against dollars backed in foreign countries. So a lot of activity is happening. But the Smithsonian Agreement doesn't hold up. So even though it creates the forward currency contracts and it creates the euro-dollar phenomena, it really doesn't hold water in keeping currencies controlled. And so the European Union tried to create a European joint float, in which the European currencies would be on a peg to one another. And it just doesn't work. The rest of the world has had a taste of what it's like to be capable of importing or exporting goods based on the value of your currency and whether it's strong or weak compared to others. And in 1973, both agreements are scrapped and the world goes to an open marketplace. And during this free float, we see currencies move in wild fashion, where once before the float had forced currencies to only have a maximum of a 1% move in an up direction or a 1% move in a down direction, we see wild fluctuations extending as far as 20 to 25% within a day. Many of these countries unable to even catch up with the wild fluctuation and speculation that were happening in their currencies. And as we'll see later, it had a huge impact. We also see a huge increase in volume. Initially in the number of currencies traded. Initially in 1970, we saw about $25 billion worth of currencies traded, primarily for those who were using import and export loans. And we see a huge jump up to 4 times as much, approximately $100 billion worth of currencies being traded, just in a 3-year span. So this is definitely something that the rest of the world wanted, they needed, and they got it. And they more than were happy to jump in and trade currencies in an excited fashion. And the U.S. really doesn't know how to cope with all of this. You know, we have the Vietnam War, we finally were off the gold standards, but our predominance as a manufacturing country begins to slow decline downward. And we see gold prices up, we see oil prices up, we see all traditional commodities going up, we see real estate go up 3 times as much now that the dollar had been weakened against gold. And we get into a situation where there's absolutely stagflation in the economy, where individuals are not getting paid more, but the rest of the country is in a huge inflationary period. Most people simply just didn't recover from this wild change in how currencies were being traded. And it had a huge impact during that time period. Which brings us all to today's currency world. We have the exact same 3 case scenarios that affected the 1950s development of the pegged U.S. dollar system and the 1970s currency meltdown that occurred, where we moved off of the peg system onto a free-floating economy. And currently we're on a perpetual war against terrorists. So this has affected our economy and economies around the world. We've seen many currencies no longer exist. We saw the disappearance of the Iraqi currency. We've seen the disappearance of the Afghanistan currency. We've seen the disappearance of all of the European currencies, Western European currencies anyway. And this leads us to the next parity, where now with the introduction of the European currency, the dollar and the European currency, for all intents and purposes, are now pegged to one another. So whereas gold was how everything was pegged, the dollar and the European currency are actually moving from time to time in lockstep. And we saw this in the technical analysis chart in Speculating with Futures and Traditional Commodities, the second half, that these currencies are now following each other and trading with one another just as if they were dollar to the gold or the euro currency to the gold. And now there's a strange relationship going on where when the dollar is strong, gold is up. When the dollar is weak, gold is down, or when the euro currency moves a certain way. So there's now a triumvirate relationship between these 3 items that is propelling us forward. And then lastly, we're seeing oil prices are aggressively up and gold prices are aggressively up. This could be the 3rd phase of currency development. Who knows where currencies are going to go into the future? It's an industry that's only been around 30 years, but yet trades $1.5 trillion daily. So we're in a situation where there are going to be many opportunities, very many exciting chances to do very well with foreign currencies. And if you keep your eyes open and you understand the fundamentals of what affects currencies, you too will have opportunities and chances to take advantage of this wild, volatile time. So in no way think that this market's mature by any stretch of the imagination.